Hi, my name is Warren Dueck, and I'm here with my socially distanced colleague, Stephen Flynn.
Good morning, Warren.
Welcome to Andersen Tax Talk, U.S. 2020 elections, tax implications for Canadians. Now, people say, this was a U.S. election. Why are there tax implications for Canadians? Well, there's a bunch of reasons there. Firstly, our economy is impacted by things that happen in the U.S. Canadians, we all know that. It's the elephant sleeping next to the mouse. The American economy gets a cold, Canada gets the flu. We're impacted by those things. Secondly, I think, too, changes in U.S. tax law foretell often changes that happen in Canada. When the U.S. thinks tax rates should go up, somehow Canadians think, or the Canadian government at least, thinks that tax rates should go up too. And conversely too, when U.S. tax rates drop, Canadian tax rates are under a lot of pressure. And lastly, Canadians, we all know we always compare ourselves to what happens south of the border. So we're always very interested. It's on our news every night. And we've all paid a lot of attention to the election, whether directly or indirectly, intentionally or unintentionally. So there's a lot of things that have happened in the U.S. with this election. And arguably, this election's still happening, at least in the minds of some people. Now, it's an interesting election. Of course, President Biden has been acclaimed the winner, and I fully expect that he is the winner. But the Americans elected a split government. This is the U.S. equivalent of a minority parliament, in that you have a Democrat as president, but has little ability to actually pass laws through Congress, where he has a Senate that right now is in Republican hands. And as of January 5th, when there's a runoff in Georgia, will probably be the determining factor. But my suspicion is, I think most people are saying that it's likely to be Republicans elected in Georgia. The only way the Democrats get control of the Senate is if both Senate seats in Georgia went to the Democrats. Most people are thinking that's unlikely. The Democrats lost seats in the House, and that was unexpected. There's a lot of things that are unexpected here. So the real question is, will President Biden be able to make tax changes? Well, we're going to talk about what those changes are, but there's a real question there as to what changes will be. Now, all of us know, not just tax people, all of us know two things in life are certain, and that's death and tax. So we're going to talk about that first. But I want to remind you that you can ask questions. You can put those with the question and answer button, the Q&A button on your screen. And you're welcome to ask questions as we go along here. We look forward to answering as many of those as possible. So thank you for joining us. And Steve, we're going to start off with you talking about the death and taxes part.
The fundamental thing we always talk about, the two basics in life, death and taxes. So one of the more significant changes that President-elect Biden is trying to introduce is on estate or death taxes. And it's helpful to have a little background on what this is, because the concept in the U.S. is a little bit different than it is in Canada. In general terms, in Canada, death taxes, if someone passes away, in general terms, it means that their deferred income, things like RRSPs, registered pension plans, those are now subject to tax. If they have unrealized gains on certain assets, investment portfolios, real estate, those are subject to tax on the gain portion of that. And there are some exceptions for married couples, etc. The U.S. is quite a bit different. The U.S. has what's called an estate tax, which is a tax on the value of the property, not just the gain realized.
So if I have $100 million in my bank account and I'm in Canada and I die, there's no tax because there's no appreciation on that $100 million in my bank account. But if I have $100 million in my bank account and I'm a U.S. citizen, I've got potentially $40 million of U.S. estate tax, even though there's no appreciation.
Well, that's right. And so it's a very different concept because it's a tax on value. And a lot of people will say it's a bit of a regressive tax, or a sense that it's another level of tax on capital that's already been taxed once. What the U.S. does do is they provide an exemption, a lifetime exemption for your first certain amount of value that's exempt from this estate tax. And this estate tax, should it be levied, it starts at about 18% and it can get as high as 40% under current law. So under current law, the exemption per person, if you're a U.S. citizen or if you're a U.S. domicile, is $11.6 million. And that exemption was introduced in 2018 as part of the Trump tax changes, but it has a sunset clause. It's only available for 8 years. And under current law, if nothing else changes, that gets reset after 2025 to about $6 million. And if you look at the law, it goes down to about $5 million. There's adjustments for inflation. So every year that exemption amount increases a little bit. We get to the point where it may be $6 million in 2026, but in 10 or 20 or 30 years, for a lot of people when it's a little more relevant, that inflation can jump it all the way back up to 10 or 12 million. President-elect Biden has proposed a couple of things and a couple of major changes for estate taxes. One would be a lowering of that exemption all the way back to the 2009 level. So back in 2009, the exemption level was $3.5 million, and the estate tax rate got as high as 45%. So fairly significant change.
Yeah, so what's the hit for Canadians here? I mean, why these are just the U.S. exemption rates? How does that impact Canadians?
Well, right. So Canadians a little bit different. So I've talked in terms on this graph here of U.S. citizens, U.S. domiciles. So for Canadians, it's a little bit different. We don't get the full amount of these exemptions. What we get is a prorated amount for the exemptions based on the amount of our U.S. assets to our total net worth. So it's a percentage. So for example, if you were invested in U.S. securities, Google, Apple, those types of U.S. companies, or if you owned U.S. trades or businesses or had other types of U.S. assets, including U.S. real property interests, whether they're your vacation home, a rental property, even a timeshare, the value of those assets would all be subject to U.S. estate tax if you passed away owning them, even though you're not a U.S. citizen or a U.S. domicile.
So, but if I have those assets in RSP, they're still subject to U.S. estate tax. But if I own a Canadian mutual fund that has U.S. assets, I wouldn't be taxed on those.
Well, that's correct. And so there's a laundry list of all the different types of assets that are considered what are called U.S. situs assets. And so it's a formula that basically takes, for example, if your net worth was, under current law, if you had net worth of $15 million, and if you had $1.5 million of U.S. assets, let's say it's $1 million property in Hawaii and it's $500,000 of securities, that's 10% of your net worth. You get 10% of this exemption, and as a result, because your value of your assets is over that amount, you'll pay some U.S. federal estate tax.
You know what I get? In spite of these, this very large exemption right now in 2020, and it diminishes in 2026, and Biden wants to push that even lower, is the U.S. is an expensive place to die. It's a cheap place to live. Unfortunately, Canada's motto is the reverse. It's an expensive place to live and a cheap place to die. Nobody has ever used that as a logo or a slogan for "Come to Canada" yet, but that's what it is.
So it's helpful to go through an example, just to give people a sense of what the U.S. estate tax means to Canadians who have ownership of U.S. property. So in this example, we've got a worldwide estate, let's say, of $8 million, and that worldwide estate is everything the person owns. It's their house in Canada. It's their business, it is the value of their pension funds, and it's the value of their vacation home. And let's just say, for sake of example, that vacation home is worth $500,000. And so right now, if someone was to pass away today, they wouldn't be subject to U.S. federal estate tax. In about 5 years, when you look at that exemption level decreasing from $11.5 million down to about $6 million, well, now this $8 million is over that. So when you do the proportion and the calculation, your estate tax liability is about $22 million. President-elect Biden is proposing that once the estate tax...
$22,000.
$22,000. President-elect Biden has then said, with the reduction of the estate tax exemption down to $3.5 million and the potential increase of the rates to 45%, that the estate tax exposure would be $71,000.
Now, that tax would apply even if the vacation home, you bought it one day and you died the next day.
And that's what catches a lot of Canadians off guard, is they're thinking in Canadian law terms, they're thinking, well, I bought this vacation property, it hasn't gone up in value, I don't have any problems. And that's the case, is that the moment you own it, you own a U.S. situs asset. you now have exposure to U.S. federal estate tax.
So I wouldn't have any Canadian tax in that scenario, but I would have this U.S. estate tax.
Well, that's true. That's true. We've got some other examples here, just to go through that. So in addition to the changes in U.S. federal estate tax law, President-elect Biden is also proposing to remove the step up or the increase in basis on death too. And this is a different
step up and increase in basis. That sounds like a tax term. What's happening here?
Well, absolutely. So the idea here is that under current law, when someone passes away, they are subject to the estate tax I described. However, any increase in value, any appreciated gains or unrealized gains on their assets isn't subject to income tax or capital gains tax. Their beneficiaries inherit the property with a new cost basis equal to whatever the fair market value is when the person passes away.
Yeah.
So you escape income tax or capital gains tax. And a lot of families can transfer businesses from one generation to the next and not have to worry about that capital gains tax on death. What President-elect Biden is proposing, and it's the same proposal that President Obama had proposed or attempted to propose a dozen years ago, which was to eliminate that increase in the cost basis. And so it's not like there'd be tax on death, but at some point down the road, when that asset is sold or the gains are realized, that the beneficiaries would pay income tax when they didn't have to before. And so in the example we've got here, if we take that $500,000 property value, and let's assume that there's a cost basis of $400,000, under President-elect Biden's proposals, at some point down the road, there would be a capital gain of $100,000 and potentially income tax of $20,000, assuming it was a long-term capital gain. So what's happening now is you've now got two levels of taxation. You've got the estate tax we talked about of $71,000 under his proposals, plus the $20,000 at some point down the road of income tax, total of $91,000.
So this would apply to U.S. real estate. And would apply to other personal property held in the U.S. If you've got a car that's appreciated in value, I don't know that happens very often, or artwork in the U.S. and you're subject to U.S. estate tax. But interesting enough, if you own shares of Zoom, which you're watching this production on right now, is it wouldn't apply because you'd be subject to U.S. estate tax on the Zoom shares because it's a U.S. corporation, but you wouldn't be subject to U.S. income tax on it because the U.S. doesn't have taxing authority for income tax purposes on shares of U.S. corporations. There's some very limited situations that applies.
Absolutely. Well, what it's resulting in is multiple levels of taxation, and I think a lot of Canadians have to kind of rethink their estate planning strategies if they have U.S. assets. These taxes can be creditable in Canada on death, but we're adding a different level of tax and potentially tax that occurs in the U.S. at a different year at a different time compared to the Canadian tax. And if you ever get a situation in cross-border planning where you have tax in one country that happens in 1 year and tax in the other country in the other year, and if they're not incurred by the same individuals, you could get a situation where that gain or that appreciation of value is taxed twice, and you get into these double taxation systems.
So what type of solutions are there for people to deal with this? Because a lot of our clients came to us and said, hey, my estate is less than $11.6 million. So I'm not exposed to U.S. estate tax, but it may be worth more than $6 million by 2026. And if Biden is successful in reducing it to $3.5 million, that means there's a lot of homeowners in Vancouver and Toronto that are over that threshold already.
Sure. Yeah. Well, and I think everyone's situation's a little bit different. Any kind of analysis on this needs to go through that individual's net worth, where they expect to be in a few years, what their estate plans are, what their plans are with their U.S. securities. If they plan to sell the property in the U.S. within 10 years and are in good health now, they may not be so concerned about exposure to U.S. federal estate tax because as long as they don't own the property on the date of their death, they wouldn't be subject to estate tax.
That's tough to plan for.
Well, it is, and certainly when the numbers are a lot bigger, and if the plans are such that they want their children to take over the U.S. property, or they just plan to hold on to it, you can look at other structures. You can look at partnerships or trusts or corporations. They may have some merit. You can look at life insurance as a planning strategy to fund that tax. I've got some clients who've told me that, I need to understand what my exposure is. I need to understand what it is, but I'm prepared to pay it. I mean, there's enough liquidity in my state that I'm not prepared to get into these complex strategies. I just want something simple. So,
one mistake a lot of people make is with regards to their U.S. vacation property, Canadians make, is saying, I'm just going to gift it to my child. Well, there's two tax implications there. One is there's a Canadian income tax exposure on that. And secondly, it'd be subject to U.S. gift tax. Now, we don't often think about gift tax in the U.S., but gift tax, well, it has the same tax rates as a state tax. It's not a good answer because gift tax is not creditable against Canadian income tax. And so there'd really be a double taxation element there for people gifting property. So that's usually a bad solution.
Absolutely.
To do that.
No question. There's a lot in this topic here. We want to make sure that if there are any questions out there, that we could answer them. Krista, is there any questions on this topic?
Yeah, good morning. There are 3 questions currently outstanding. And the first question that we have is if you could clarify how an RRSP attracts U.S. estate tax and stocks owned in an RRSP.
Well, an RRSP is just, from a U.S. perspective, is an investment account. And the tax treaty says the income taxation of it's treated differently. But for estate tax purposes, it's owned by the individual, albeit indirectly, and the assets in it are subject to U.S. estate tax if they're U.S. situs assets. And that's things like U.S. shares. Would be the principal thing in an RSP.
Perfect.
That voice you hear in the background is Krista Rabideau. She's a tax principal in our Calgary office, and she is monitoring all the questions today and helping us along. So thank you, Krista. You said there were 2 other questions?
No problem. Yeah, there is. And one other question is, can you address the impact that this would have on U.S. and Canadian citizens? So Canadian resident, U.S. citizen, is it any different?
So the biggest difference there as a U.S. citizen is that you receive the full amount of the exemption. So we went through that under current law, it's 11.6 million. It'll get down to 3.5 million should the Biden tax proposals get enacted. But the other difference is for a U.S. citizen or for U.S. citizens in Canada, they're subject to a state tax on their worldwide assets. So it isn't just U.S. situs assets, it's everything they have, their business in Canada, their home in Canada. So it's a different calculation, it's a different set of rules, and there can be different strategies we'd employ there.
And those same rules would apply to U.S. domiciles, which is distinctive from U.S. residents. Most people think of green card holders. They're residents for U.S. income tax purposes, but domicile is a different question. And so U.S. domiciles and U.S. citizens are both subject to U.S. estate tax in the worldwide estates.
Absolutely.
Perfect, thank you. And there's just some clarification questions that have come in. So to clarify, if the worldwide estate is more than 3.5 million, but the U.S. real property is worth 1 million, would there be U.S. estate tax? So worldwide estate greater than 3.5 and $1 million U.S. real property.
So greater than 3.5 million, of course, we don't quite know what that is, but if we assumed under current law that the estate was somewhere between over 3.5 million and under 11.6 million, it doesn't matter how much the U.S. estate assets are worth, there would not be any exposure to U.S. federal estate tax. However, if you look at the Biden proposals, and once that exemption goes down to 3.5 million, then yes, any worldwide estate between 3.5 million to 11 million would have exposure to U.S. federal estate tax. And if the U.S. situs asset is $1 million, depending on the net worth, that could be 200 to 300,000 or more of U.S. federal estate tax exposure.
Now, talking about U.S. estate tax is always fun. So we led with the interesting topic, death. Let's go to something else now, and we'll talk about changes in U.S. corporate tax. Thanks, Steve. And Biden has also, of course, corporations are always kind of lambs for the slaughter in political contests because, there's no voter is a corporation. So there's always an enthusiasm to increase corporate taxes. This chart gives you a comparison of Canadian and US tax rates. Of course, the small business tax rate here at the bottom here, 11% and varies by province on the first $500,000 of taxable income. Very attractive tax rate, obviously way better than the US. If you look at the standard rate for an active business in Canada, it's about 27%, varies between about 25 and 29, again, depending on province. But in BC, it's 27%. And that is actually almost identical to the existing US rate. You talk, the US federal rate currently is 21%, and the average state tax is about 6%. So Canadian rates and US rates since the Trump tax reform, virtually identical. Now, maybe that's sad news for accountants like ourselves, because we're always trying to figure out how to take advantage of things from a tax perspective. But where the rate's the same, there's really no motivation to say, where do we earn income, in Canada or in the US? Which is better? You know, they're essentially the same. But that's when things start to change. Biden has proposed that the corporate tax rate would go to 28% federally, and we'd add on state tax rates of 6%. That suddenly twists up that number to be a fairly significant difference. So you're talking about a tax rate of 34% in the US versus 27% in Canada.
So tell us a little bit more about the state tax rate and how we get to 6%.
Well, 6% is really just an average. I mean, the interesting thing here is state tax rates vary quite substantially from 0%. States like Washington, Texas, Wyoming, Nevada do not have corporate income taxes. So they have other taxes. They don't have a corporate income tax. Whereas other states like Minnesota, Pennsylvania, they have state taxes that are over 9%. California's is just under 9%. So there's quite a range in those state tax rates, and they can be much higher than in Canada. And so there's a big difference there, and this is a competitive advantage for Canada. Now, unfortunately, as I said earlier, Canada kind of sees that when rates go up in the US, maybe we can raise rates in Canada. And there's certain groups in our government that want to think that more is better, and including more taxes. I'm not sure that any of our listeners are thinking about that.
This is an interesting graph, and it shows kind of the movement, but it hasn't always been like this. In fact, recently there were some fairly big changes in the US.
Well, the US, before the Trump tax reform, that was 2017, became effective in 2018. Before that, the US federal income tax was 35%. Plus you added on state tax, you're talking about rates over 40%. So was a real bias for Canadian businesses to earn profits in Canada rather than the US. Now, a lot of people think, well, what do you mean I earn profits in Canada? All my sales are to the US. That doesn't mean that's where the profit-making part of the business is. And we'll explore that in just a moment here in terms of different ways that you can deal with that. But that's one of the strategies here is there's an advantage to earning profits in Canada if Biden is successful in passing those rates. Now, one of the alternatives here is saying, could you avoid US federal income tax? Well, you can. It's actually pretty easy. This is the law. We're not talking about some really sneaky thing we dreamed up. It's not. This is how the law works. It says that you will not be a Canadian business will not be subject to business profits in the US unless there's a permanent establishment in the US. So in a world prior to Zoom and the digital life we now live in, we always used to think of things like bricks and mortar. Like to do business in the US, you had to have a store or an office or place of business. Some of those things aren't really true anymore, and they become more focused now. The treaty between Canada and the US, the tax treaty, defines it saying a permanent establishment is a place of management. It's a branch, office, or a factory. In the case of the in natural resources business, it's an oil or gas well or mine. Building installation sites can be it. If you offer services in the U.S. for more than 182 days, and there's some specific thresholds there, you can have a permanent establishment. But if you're a lawyer sitting in Calgary, or you're an architect in Vancouver, and you go to a business meeting in Chicago or Denver, and you go to the meeting, you come back and you do your drawings or develop your contracts or agreements in Canada, you don't have a permanent establishment. Even though the customer's in the U.S., even though you get paid U.S. dollars, there's no U.S. tax result there, and or no U.S. federal income tax result. So this is one of the things that businesses that have an ability to do this, to avoid having U.S. permanent establishment, can avoid U.S. federal income tax altogether. Now, at current U.S. federal tax rates, there's really no advantage to doing that. But if Biden is successful in raising rates, what happens? And it's not going to be unique to Canadian investors. They'll say, I still want to keep doing business in the U.S., but I may change the way I do that business. I can do it from my office in Winnipeg or in Toronto. I don't have to be in Denver or in Los Angeles. And so there's an opportunity there. And that goes not just for professional services, but even things like if you sell strawberries. Do you have to have an office in the U.S. to do it? I don't think so. You'll probably ship your goods to the U.S. It also for software and other consumer goods where you don't physically have to be there. Now, some goods, some businesses do require people on the ground, but you may escape U.S. federal income tax, but you'd be subject potentially to state income tax. But state income tax, we said, were the small part. Federal income tax are the big part. And as long as we can get a credit for those state income taxes in Canada, we're not really that concerned about it.
So it's one of those things where we're avoiding U.S. federal income tax on this income we don't have a permanent establishment. But we still have the obligation to tell the IRS about this. As a business, if we're relying on a tax treaty, which we are between Canada and the United States, we've got an obligation to file a tax return every year with the IRS. There's no calculation of income tax, because as Warren had said, there's no tax to pay. But we need to lay out what site the treaty we're relying on. There's some more facts we have to rely on. There could be some penalties assessed if we don't file this return on a timely basis. The IRS has the ability to deny expenses if the IRS ever concluded that we did have a purpose management. So as much as we're avoiding the income tax liability, in most cases, we still have an obligation to file a tax return.
That's right. So paying tax doesn't mean you can avoid filing a tax return if you're not subject to that. So we'll just flip here. Now, not everybody can avoid having a permanent establishment, but that doesn't mean you can't do some things that would alter the tax results here. That's things like transfer pricing. If you develop a product in Canada, you sell it in the U.S., where does the profit get realized? Well, in some cases, most of the profit should be recognized in Canada. This is where the product was developed. This is where the brain trust is that created the product. All those things happen in Canada. It's only the very last part of the activity that occurred in the U.S. Management fees. Businesses with offices in Canada and the U.S., if the Canadian office is looking after the accounting, it has all the executive functions, there's a bunch of other things happening in Canada for the benefit of the U.S. organization. Those costs should be borne by the U.S. organization. And our bias here, where the U.S. tax rate is higher than in Canada, is to push profits to Canada. In other words, we want to have more expense in the U.S. and less in Canada. Now, you can't just choose to have any amount you want. In other words, these are arm's length costs, and there's some other factors you need to think about too. Things like royalties and interest. You have a certain technology that you employ through your U.S. affiliate. You could charge a royalty. Interest with the debt between parties can do the same thing. So there's lots of opportunities here. Krista, do you have some questions for us?
Yeah, there has been a couple questions that have come in. The first one is, if I set up a Nevada corporation and do business in California, am I subjected to California tax?
Yeah, the place of incorporation does not determine your state income tax obligations. So there's a lot of businesses set up in Nevada and Delaware in particular. I mean, I'm going to say 499 of the Fortune 500 are incorporated in Delaware. I may be a little off there, but why do they do it? It's not strictly for tax purposes. Often they're setting up in those jurisdictions for other reasons, and particularly for public corporations. It simplifies a bunch of things for them there. But from an income tax standpoint, you'll be taxable on where you conduct business. And for state tax purposes, that's actually different than what it is for federal purposes. State tax have a concept of nexus. And a nexus means basically if there's in that state property present that's owned by the business or personnel of the business present, you'll be taxed on that state. And more recently, the courts have found, and there's a very famous case now called Wayfair. I'm sure you've all heard of Wayfair, especially as you're shopping at your home during COVID. Wayfair, the case said you could be subject to state income tax even though you don't have property or personnel there, but because you have economic nexus in that state, that your sales in a state exceed certain thresholds.
And more states are moving towards that concept of a non-physical presence or an economic or a click-through or these other different kinds of nexuses where you may have never set foot in that state, but you may be subject to income tax and state sales tax and other tax obligations by just doing business with the state.
Yeah. Any other questions, Krista?
Yeah, there's one that just came in. So if you have a Canadian corporation that is doing business down in the United States and is exempt from tax under the treaty, so no PE, however, they pay state tax as they are operating in a state that doesn't follow the treaty, how do you claim that in Canada? Is it a credit or a deduction?
Well, in most cases, it'll be a credit. It has to be an income tax in the United States to be a credit. For example, I mentioned Washington State does not have an income tax, but it does have what's called a business and occupation tax. It's an excise tax. From a business owner's perspective, so they're both a tax, but the excise tax, the business and occupation tax in Washington State is not a creditable tax. It's deductible. That means you're not getting a dollar for dollar return on that. I'll just make one comment about an earlier question. Someone said, if I incorporate in Nevada, like I say, Nevada's not a bad place to incorporate it, but you want to be careful about your ownership structure. That's not going to be part of this discussion, but having a Canadian person directly own a U.S. corporation is not generally giving you the best overall tax result. Steve?
So we're going to shift gears here and we're going to talk about personal tax rate changes. And one of the proposals and one of the platforms we heard President-elect Biden talk about again and again was that there would be no personal tax changes except for people in that kind of 1%, the high income earners. And he was clear that he wanted to make sure that anyone who was making $400,000 or less wouldn't see any changes to their personal tax rates. And so when we go through it, it's important to say, well, here's what the U.S. tax rates are. But I think it's also instructive to say, well, how does that compare to Canada? Because when you look at it, there's kind of two striking things. And this graph here is probably one of Warren's and ours favorite graphs. We've used this and written this on whiteboards and flip charts and drawn it in sketches and all sorts of things. And it's the idea that when you're trying to compare the two countries' tax law, it isn't just the top marginal rate you're worried about. It's how do we escalate to that, and where does it chop, and where does it actually climb? And so we've got two examples here. We got three scenarios here. We've actually got one family here, and the example family would be a married couple where one spouse is working, the other isn't. And let me back up. We've got an example here where both spouses are working. And let's just say, for example, that they're residents of Canada, and we're going to put them in British Columbia. And so when you look at the Canadian tax rates on each individual, the top marginal tax rate gets to 53.5%. And it gets there fairly quickly at about $220,000 of taxable income, and it stays there. And so you're getting up to that rate fairly quickly. If you compare that to the U.S. system, we don't get to the top marginal tax rates as fast. And so there's this fairly big gap in between here. So for example, to do an apples to apples comparison, we'll put this family in California. So we'll have federal taxes and state taxes in California, same way we had federal taxes and British Columbia taxes in this rate here. So with this same couple, they don't get to the top marginal tax rate till about $800,000 of income. And then it's 37% now for federal tax. California's about 13.3, so call it 50%. So we got a small gap here, but the bracket didn't kick in until about 4 times as high as Canada. So this huge gap is how much more income tax we're paying in Canada compared to the United States. Go back to Warren's favorite saying, Canada's an expensive place to live, a cheap place to die. And so this is one of those examples of that.
Wow, that's huge. And you don't actually hit the top California rate until you're over $1 million US in taxable income. Ouch, that hurts. Our Canadian government doesn't want us to see this chart because they want to say, oh, no, our rates, California, you hit a top marginal rate of, well, it's just under 50% under current law. California had actually proposed a law that would get it to about 54% or equal to the rates in BC and similar to those in Ontario. And that's huge. If you're LeBron James and you're earning $10 million a year, I'd suggest you don't really care that much what that difference is. Most of us aren't in that category.
Absolutely.
I always wanted to dunk a basketball, but I can't.
The Biden proposals suggest that individuals earning more than $400,000 a year, their top marginal tax rate will go from 37% to 39.6%. So as Warren says, it doesn't kick in until you kind of get to that high income level. And even then, it's still not hitting when you add the new federal tax rate under the President-elect Biden's proposals plus the state rate. It still doesn't hit Canadian rates. And so in thinking about this from a Canadian's perspective, there may not be much difference. We may be paying a little bit more U.S. federal tax, but in situations where we've got, say, income and someone's resident of Canada, but they're working in the U.S. or they've got property in the U.S. they're trying to sell, as long as we can claim a foreign tax credit for all the federal and state taxes they've incurred against Canadian taxes, we're no different than we were before. We're paying a little more tax to the U.S. government, perhaps a little less to Canada. The only scenario I could think of is one of President-elect Biden's proposals was for families with a taxable income over $1 million, the rates for qualified dividends and long-term capital gains are potentially going to change from what's currently an incentive rate or a lower rate of 20%, and those can go as high as 39.6%. And so if you thought of a scenario of a high net worth, maybe a high income Canadian who's either going to sell U.S. real property and might have a big long-term capital gain, and let's say that property is in California and it's the situations we're seeing again and again where Canadians can't use their property in the U.S., they can't travel because of COVID, they don't know when they're going to get back there, so it's just time to sell it and kind of move on. If that individual had more than $1 million of income in a year, potentially that capital gain could be subject to federal tax at 39.6%, state tax at 13%. We add those up and that's the 52% we talked about. But Canada's capital gains rates are only 26, 27%. You might have a unique situation where the U.S. tax is higher than the Canadian tax. I don't know how many scenarios that would come up with, and the success is going to be in the details of how that high rate applies, but that's a potential.
So that would be specific for the subject we talked about earlier, U.S. vacation property, another real property. It wouldn't apply to the shares of Google or Zoom or things like that, because those aren't subject to U.S. income tax if you're not a U.S. citizen or resident. In other words, Canadian residents who are not U.S. citizens wouldn't be subject to that. And there's another factor in that too, is that U.S. vacation property, not only in Canada where they play for any gain in the price, but potentially there's a foreign exchange gain if the US dollar rises in value.
Well, and this is catching some people now as they look at their situation, people who bought, say, 7, 8, 10 years ago when the Canadian dollar was at par. And now we've got, say, a currency exchange rate of $1.30 or $1.35. Not only do you have some real appreciation in US dollars, but you get this additional foreign exchange gain that could almost double the gain you expected.
The biggest thing that worries me about a situation like this in the U.S. where they do raise personal tax rates is, again, our government in Canada says, oh, U.S. tax rates are going up. we could do the same thing in Canada. Surely Canadians might want to pay more now that Americans are paying more. If they could take out this gap here, I'd be a lot favoring higher taxes over here. I think most of our listeners would say the same thing. But there's a huge difference, even where the rates are comparable between Canada and the US, and you can see the rate structure is hugely different here. That's just, that's awful.
Yeah. Krista, what questions do you have from our viewers?
No questions right now on U.S. personal rates specifically. However, there was one question about selling U.S. property and not having a taxpayer number. Is there a way to get that?
So I've seen this happen 2 times where Canadians who are not U.S. citizens, they've never worked, they've never lived in the U.S., so they have no identifying number for the U.S. government. They don't have a social security number, and they go to sell their property, and their escrow agent, the title company, says, well, we need your taxpayer number. And they think, well, I'll just give them my Canadian social insurance number, but that's not effective because that's a Canadian number, that's not a U.S. number. What the escrow agent, what the IRS is looking for is something called an individual taxpayer identification number. That's a unique 9-digit number that gives you a couple things. It identifies it with the IRS, it allows payments to track of that number, and when you go to file a tax return, it enables you to probably file a tax return and get credits for everything that's been done and pay your tax liability. A lot of people will not have that number, and it can take 2 to 3 to 4 months to apply to the IRS. There's a process you go through, and oftentimes you don't have 2 to 3 to 4 months to close on your property. It's got a 30-day close or less. I tell clients, don't panic. There's a methodology you can do to close your property without a taxpayer number. There may be some withholding tax that gets sent to the IRS by the escrow agent. That gets funneled through in a process. There's a methodology the IRS has to track that payment. And eventually, when you do go to apply for your number, you'll get credit for that tax withheld, and you'll be able to file a tax return.
Steve, we picked on California here because it and New York have the 2 highest personal income tax rates in the U.S. for state taxes. I mean, some states are trying to push that number. I think New Jersey has a relatively high tax rate too, but where do other states fit in that state income tax rates?
Well, it varies. Just like corporate taxes, David and Warren talked about that. Some states have no personal tax liability. Washington State would be a significant one for us. Other states will have it in that kind of 10 to 12 range. It really depends on how the state funds its own spending. The interesting thing with Washington State is when you look at a comparison of, again, taking this graph here, of a Canadian who's working here, let's say it's a family with one income earner and they're making $300,000 a year and they're living in Vancouver, they've got a tax liability. It's going to be high because it's Canadian taxes. That individual files his or her own tax return at $300,000. They're subject to tax at the top marginal rate for a good chunk of their income. If the family moves to Seattle, you can do a couple things. One, you can file a joint tax return. And 2, you can take advantage of these lower marginal tax rates. And in particular, you're not going to have any state personal income tax. That family might save $70,000 to $80,000 a year in their tax liability. It's a significant difference.
So some of those states without income taxes in the U.S. include Washington, as Steve mentioned, Alaska, Wyoming, Nevada. Those may not be as attractive for you to go to, but they also include places like Texas and Florida. And so I always think when hockey players or basketball players sign new contracts that are substantial, they're going to, Dallas or Houston or Miami, they've kind of cashed in on the tax side. Those are low tax jurisdictions, but Seattle is too, actually. So it's a good place to do business.
This is the Seattle Kraken are going to attract more players?
The Seattle Kraken. Have you got your jersey yet?
I don't.
Okay.
Our next topic is actually right on topic with that, because we talked about personal income taxes on that example I gave you. But there's another level of taxation called Social Security or payroll taxes. And Warren, why don't you take us through that?
Sure. So in Canada, we're all familiar with Canada Pension Plan, and because it comes out of our paycheck every week. And the one thing that when we work with Canadians that move to the US say, hey, I looked at my paycheck and I thought something was wrong. There's this thing called U.S. Social Security tax, or more likely it's actually identified on their paycheck as FICA, F-I-C-A, that stands for that should be in our test, actually, shouldn't it be? Our quiz. The Federal Insurance Contribution Act in 1933, it was 33 or 34.
Full 10 points more, yeah.
Yeah, is FICA or Social Security and Medicare tax are significant relative to Canada. Now, people say, hey, U.S. Social Security, but that's great because the benefits out of U.S. Social Security are 3 times higher than Canada. We'll walk through this chart here, but you'll see, but the costs are 5 times as much. This is a government mandated savings program. And if it was so good, and a lot of people think it's like manna from heaven, if it was so good, you wouldn't have to require people to do it. They'd be throwing money at the whole thing. Canada Pension Plan and U.S. Social Security are, full disclosure, they're bad investment plans, but you don't have a choice. And so the question here is really about, could you have a choice between the two? Because as you'll see, Canada Pension Plan is a fraction of U.S. Social Security costs. So we've just done a little bit of chart here saying on Canada Pension Plan, if you're making $500,000 or $1 million, your total cost, these are all in US dollars, about $2,300. The employer matches it, so the total cost is $4,600. If you're self-employed or you own your own corporation, you pay the $4,600. It caps out in 2021. I think the threshold is now $61,000 Canadian. So if you have earnings above that, they're not taxable. So that's your maximum payout. That's pretty good. When you compare it to the US, that's where you start going to shock here. Someone who under the current Social Security rates is making $500,000 would pay about $18,000 in US Social Security and Medicare costs. 18,000 US. That's almost 10 times as high as the Canadian rate, probably about 9 actually. And that's a huge difference. And if you're making $1 million, it's almost $30,000. That's massive. Now, Biden, again, has said, hey, I think we should have people pay more for Social Security and Medicare tax. I mean, this is kind of free money to the government because they get to invest it and use that money in the meantime. He's suggesting that if you get over $400,000, the rate would jump up, or you'd be taxed on that. And so you'd end up with almost $25,000 that rate. And once you hit $1 million of earnings, you're talking about almost $68,000. That is massive compared to Canada.
So President Biden's his proposals are a bit unique in the sense that there's a rate for the first 150,000 or 130,000,
right,
and it's high. It's 12% or 15%, whatever it is, and then it drops to a fairly low rate,
right,
at about $400,000, and then it goes back up again. And so there's almost like this, and our Andersen colleague called it a donut hole, or like this kind of strange plateau, or not plateau, it's kind of this dip that's kind of a significant hole, but then it kind of ramps back up again for high income.
Yeah, well, Biden's proposals all say, like, if you're making over $400,000, we're gonna spank you,
right, and
with taxes. And so I don't think 400,000 is where 1% start. I think you're actually starting to get pretty close to 0.1% at the level. I'm not saying they don't exist, but and I'm not sure that actually by tax them more, you actually create more government revenue, which becomes the big issue there. But at a Canada Pension Plan, it is a bargain compared to U.S. Social Security. Now, that's not going to be particularly comforting to you after we just went through the personal tax rates. We saw the personal tax rate thing. But Canada Pension Plan is an inexpensive plan, and it's a very attractive one. So the question is, well, what can you do about it? Well, this really affects principally one group of people, those people moving from Canada to the U.S., and potentially also those moving from the U.S. to Canada. Canada is really kind of unique in that its Social Security tax system is one of the lowest in the developed world. It's also one of the most new ones too, in that it came into play in the 60s versus the US was in the 30s, as I mentioned. So it's a significant difference here between the two. And if you're moving from Canada to the US, if you're transferred by your employer, unless you have a long-term contract that requires you to be in the US for more than 5 years, that typically only applies to CEOs or rock stars or maybe hockey players. You can actually continue to be on Canada Pension Plan while you're in the US. So if your business has employees being transferred to the US, they can stay on Canada Pension Plan. There's some requirements for them to do that, but they'll generally qualify for that. Now, the flip side is Americans being transferred to Canada. And this is a really interesting subject because oftentimes Americans and arguably Canadians too have been viewed that, boy, that U.S. Social Security is really valuable to me. Like I want to pay into that so I max out my benefit all the way to the end. We've already derided that a little bit, that this is a government mandated savings plan. It's not a very good savings plan. So given a choice between being on U.S. Social Security and Canada Pension Plan, people should always choose Canada Pension Plan. Not because it's better, but because it's cheaper. And so that difference in cost is a real advantage. Now, you say these individuals are fairly unique, $500,000, $1 million. Our people are earning $100,000. We've submitted claims to both the IRS, to the IRS to get refunds of over $1 million of overpaid Social Security taxes. So there can be significant dollars there if your business is transferring people between Canada and the U.S.
Well, it's a really good opportunity, as Warren says, for those individuals that are moving to the U.S. And it's not just a savings for the individual, it's a savings for the company as well. And so there's a motivation for the company to say, okay, well, we know we've got to, perhaps seek some advice on this. We've got to go through some process. We've got to, coordinate this. But if we, as a company, can save $10,000, $12,000, $15,000 a year as well as you at that higher level, we're motivated to do that. The biggest thing that when we go through this product planning is for it to be really effective for the employee. Not only are they moving to the U.S. on that temporary basis and qualifying for this plan, but they're leaving Canada, they're ceasing residency in Canada. Because if they don't, if they're still subject to Canadian income tax, this doesn't save you anything. It kind of goes to that same thing as we just keep adding more and more U.S. taxes. But if we get a full foreign tax credit, which we would for Social Security and Medicare against Canadian taxes, we're really no better or worse off. So it has to be both qualifying on kind of a temporary transfer to your affiliate employer, but also leaving Canada and ceasing residency.
I think the interesting thing about this is most of us actually don't think about this subject very much until you get transferred. And a lot of employers and even their advisors totally ignore this issue. So there can be an opportunity here if you're in the right situation. Krista, did we have a question on U.S. Social Security tax?
There was one question that came in with respect to Social Security tax, and it was a Canadian company has hired someone that lives in the U.S. Do they have to pay into the U.S. Social Security as a Canadian company?
Yeah, the issue here really is about where the employee is based. So even though it's a Canadian corporation, if that employee is based in the U.S., they'll generally be subject to U.S. payroll tax, including U.S. Social Security and Medicare tax. If that employee is based in Canada, but maybe provides some of their services in the U.S., they'll be strictly based on Canada Pension Plan. So it's really a function of where the employer is providing their service, where they're based to do that. So I'm just going to flip to our next slide here to remind you, if you do have questions, we're glad to take them. So put them in now. But also talk briefly about some of the other things that are out there in terms of things that Biden has talked about, and we're not going to cover all the things, but in terms of tax changes. One of them that he's proposed is particularly interesting, I think, and that's something called a financial transactions tax. Now, this is a really significant deal because what it would do, it would tax trading in securities. Now, you may say, how could it be a significant deal? Because the tax rate being proposed is 0.05% to 0.2%. It's a really low tax rate. But when you start thinking about the amount of dollars that are traded on U.S. exchange on a daily basis, I frankly, I've lost track of what those numbers were. I remember when they talked about, 100 million shares being transferred. But that just kind of shows my age, I think, at that point in time. So the numbers on a per share basis are pretty minimal. But if you had $1,000 transferred, it'd be a $2 tax at that higher end of the rate. So, but they obviously add up with volume. The interesting part about this is France and Italy both have similar provisions. Now, I don't think anybody's viewed those countries as being, havens for capital as the U.S. is. Importantly, places like London, Canada, and Asian stock markets do not have any sort of financial transactions tax. If the U.S. imposed this tax, it would change how people view U.S. securities markets. And that would be anathema to Wall Street. I mean, people have characterized this as being a tax on Wall Street. But you know something, that's really, I think that's a distortion. Over 50% of U.S. households, and I would suggest to you, over 50% of Canadian households have monies invested either directly or indirectly in U.S. exchange markets. Indirectly through things like pension plans, RSPs, in the U.S. individual retirement accounts, those things all invested. So it's a tax on us, the taxpayer.
So even though people have talked about it being a tax on Wall Street, it really just gets pushed down.
It's coming out of my wallet and your wallet. That's who pays the tax. So this is really significant. And what would be fascinating to see on this one is if, because of this tax, a U.S. corporation actually decide to list on a stock market outside the United States. So that's really would be. I think that'd be stunning in the U.S. if you said Google listed on the Toronto stock market or listed on the Shanghai stock market. That would be a very interesting political discussion.
Absolutely.
There's another thing I want to talk about too. It's really not specifically a tax issue, but there is a tax section too. I know we've got a bunch of listeners in Calgary, and that's the oil and gas market in the U.S. and Canada. And Biden has said he wants to stop fracking on federal lands. And fracking, of course, is a drilling technique used to maximize the amount of oil and gas can be extracted, and has really revolutionized the energy business in Canada and the U.S. And that would have a real negative effect. Perhaps that might be an advantage to Canada to the extent that the U.S. regulates that more and Canada doesn't. Unfortunately, a lot of our Canadian law is often based on what happens in the U.S. So I don't know what ability we have to either encourage that migration if you're in favor of that, or to stop the migration of those particular provisions. But so there are some other interesting provisions. I mean, taxes are like, and we can go on and on and on, but I know there's some questions out there. So,
well, and we're just at the top of the hour here. So we want to thank everyone for participating. We've got some more time here to answer about a half dozen questions we've got. So feel free to stay with us. But that was the end of our formal presentation. And I understand, Krista, we've got some questions.
Oh, yes, there has been a number of questions coming in, reverting back to previous topics that you have discussed today. The first one is with respect to U.S. estate tax and what would happen if the property is jointly owned, a U.S. property by a Canadian person is jointly owned with children that are non-U.S. and haven't passed away. So if one of the owners passes away, what happens?
Well, joint ownership of property is always an interesting dynamic because it gives the impression of, who really owns each portion of that. And so anytime children are added on to title, I think both governments would suggest, well, is that a gift? Is that a gift of a proportional interest? And so, the question may not be what happens on death. It may be just as much as what happened when the children were added on title.
So you're back to a gift tax situation.
Well, and as Warren said in his example, gifting U.S. real property amongst Canadians is probably one of the worst situations you can get because you can have a gift tax liability in the U.S. and it's not credible in Canada. You can get a double taxation. So I would always be wary of answering a question like that. But I think you'd want to look into if someone's got that situation now, is that the right answer? Because my guess is there's probably much better answers than joint title with children.
Yeah, well, even if you take the children out of the picture and joint ownership between husband and wife, of course, that's a common form of ownership in both Canada and the U.S. From the U.S. perspective, if both spouses don't contribute equally, while it may be identified on title as joint ownership, it's all owned by the person who actually contributed the capital to make the purchase. So joint ownership can be a deceptive, can be deceiving. It also does not defer U.S. estate tax till the second to die. So even where there's joint ownership, the decedent his estate may have to pay tax even though there's a surviving spouse. So joint ownership is a very interesting question, as Steve mentioned.
Well, and it can be effective if, as you say, if family members have the ability to contribute to the purchase of property. Joint ownership may be a very good solution. It really depends on the situation. Krista, you've got another question now?
I do. The next question is a couple questions combined into one with respect to taxing of pension income. So if an individual lived in Canada, worked in Canada their entire life, and then retired down to the United States and left Canada, does that mean they only pay tax to the U.S. at the lower rates for both Social Security and private pension?
Sure. So a Canadian receives Canada Pension Plan, and let's say they have some other pension income. Canada gets to tax the pension income. So if they're employed by General Motors in Canada and they receive a pension from General Motors Canada when they're living in the US, they'll pay a 15% Canadian withholding tax. Then they'll pay US tax on top of that, but they get a credit for the 15%. So really the question is, they'll pay the higher of the two taxes in that case. In the case of Canada Pension Plan, if they live in the US, they won't pay any Canadian withholding tax. And that also is true for Americans or individuals who have earned Social Security. I live in the US for a number of years and I'll receive a Social Security benefit when I retire. And that Social Security amount paid to me will not be subject to US tax if I'm a resident of Canada.
Perfect. And the last question on pension plans is the annual benefit from the less expensive Canadian pension plan similar to the annual benefit one would receive from U.S. Social Security?
The benefits under Canada Pension Plan are less than Social Security. So Social Security feels like, boy, this is really great. But as we showed in that slide, you're paying a lot of money to get that benefit. I would suggest to you, if you're in a situation where you can avoid U.S. Social Security tax, only pay into Canada Pension Plan, if you've been transferred to the U.S., you take the difference between those two, you put it into a bank account, and you know what bank accounts are paying right now? Not very much. You earn 1%. You'll make out like a bandit compared to what you'd get from Social Security for that difference in tax. So you're always to the advantage of paying the lower rate. There's a very poor return on those investments. Other questions, Krista?
There is. So moving on from Social Security and pensions, the next question would be, do you have an example where the IRS has challenged Canadians on their tax obligation over a U.S. vacation property or similar assets in the United States?
Well,
so the rental income or disposition.
Yeah, I mean, to the extent they actually dispose of property, they're subject to a U.S. withholding tax of up to 15% on the selling price. And Steve, maybe you want to talk to rental income.
Well, yeah, fair enough. So one of the things that Canadians have to be aware of is that when they have U.S. property, they own it, if they use it to earn rental income, a couple things happen. One, unlike Canada, the U.S. has what's called a forced depreciation system. So you're forced to claim depreciation against the building portion, against the physical assets, the tangible assets you have in the property.
You have to use it or you lose it.
Right, regardless of whether you make money or lose money. And if you don't actually tell the IRS this, if you don't file a tax return on an annual basis and show your income, your expenses, your claim of depreciation, you actually lose the ability to claim that depreciation. And so when you go to calculate your gain on sale, your adjusted cost base has been automatically reduced under tax law, but you don't have those losses or any other activity to carry forward. So you got to be careful if you use it for rental purposes. I think what's just as interesting as what the U.S. might do is what Canada Revenue is starting to do over the last 6 months. Is Canada Revenue is very aware that the Canadians have U.S. properties, and they've put a bid out to tender back in the summer to a bunch of database providers in the U.S. to gather information on Canadians who are buying, owning, selling U.S. real property. Canada Revenue wants to use this information to make sure Canadians are compliant in their tax law and in their tax returns, that they're reporting gains on sale, that they're reporting the income if there's any rental activity. So Canada Revenue is getting serious about this, and they're starting to gather this information.
So and CRA has to be willing to share that information with the IRS too. The IRS can ask CRA for that information.
Well, that's right. There's an agreement between the two countries under the treaty. There's an agreement to exchange information. So the extent that Canada has information, it could easily send it to the Internal Revenue Service to say, here's who's trading properties in your country. So it's getting more and more difficult to avoid detection in both countries.
And this is a business that's really changed, this whole vacation business, when you talk about things like Airbnb and VRBO and other platforms. Those entities need to give the landlord, if you will, the vacation home owner, they have to issue IRS Form 1042 to them. IRS 1042 is for payments of things like rent to foreign parties. So, again, you're showing up on the IRS, radar screen, if you will, in that respect. And, trying to hide is always a kind of a tough business. Excuse the fact that we're do U.S. tax accounting work and compliance work, but, fighting a rearguard action is always really troubling, and you may end up with a result that's way worse than if you just complied with U.S. tax law.
Absolutely. Krista, are there other questions?
Sure has. There's more questions that keep rolling in. The next one has to do with estate tax and planning around estate tax. And if there are any suggestions who are Canadian persons that are married to U.S. citizens or U.S. citizen children, are there ways to help reduce estate tax if they're over the worldwide thresholds?
Well, I think anytime you have a split citizenship couple, there are some unique opportunities, and you got to kind of go back and say, what are the rules? Well, for a U.S. citizen, they're taxed on their worldwide income and their worldwide assets in the U.S. And when they pass away, they're subject to estate tax on their worldwide assets. In contrast, a non-U.S. citizen, and presuming a non-U.S. domicile, so a Canadian, if you will, that's married to that U.S. citizen, they would be only subject to U.S. federal estate tax on any U.S. situs assets that they own. And so you want to, look at the whole picture. And, for example, to the extent that the couple has a U.S. asset, it may make sense for example, the U.S. real property to be owned by the U.S. citizen spouse because they've got the full amount of the exemption available to them. It may make sense to look at kind of the wills and planning that for example, if the non-U.S. citizen spouse passed away first, that their assets, if they were sizable, didn't automatically go to the U.S. citizen, who would then be subject to estate tax when they pass away, but might go into some sort of trust or some sort of other vehicle that could avoid exposure to U.S. federal estate tax. There's lots more ideas there, Warren.
Well, yeah, I'm just going to bring this card back up again. Today, there's a great tax funding opportunity for those people because the U.S. citizen could transfer up to $11.6 million to their spouse free of any U.S. tax. Now, if they transfer more than $11.6 million, they'll be subject to gift tax. And there's some special rules that where the spouse is not a U.S. citizen, they can transfer a large amount on an annual basis, but they could transfer a lot of their estate, or $11.6 million of their estate, their spouse free of U.S. tax and free of Canadian tax where they're residents of Canada. So, the objective there is to avoid U.S. estate tax and push assets to the other spouse. Now, we're tax people here. We're not family lawyers, but I think generally you'll find is that as long as it stays within the marital community, they haven't given up a claim or a right to that property, but it's in their spouse's name.
One thing we never addressed is, you don't have to be a U.S. citizen the rest of your life. You can renounce your citizenship. Every year, what started out maybe 10, 15 years ago was 300, 400 people renouncing their citizenship around the world, which is a pretty small number when you think, there's 300 million Americans around the world. I don't know what it would be. But now it's more like 3,000 or 4,000 people a year that are renouncing their citizenship. That might be an effective strategy. There's a whole host of exit tax rules, transfer tax rules that one's got to be aware of. But, if you're looking at kind of that long-term planning, if that makes sense, that would be something to consider.
Anything else, Krista?
Yeah, there sure is. Sorry. So
how about two more questions?
2 more questions, sure. How about 3 more?
Yep, we'll accept 3 more.
All right, the next one should be fairly quick. Dual citizen, Canadian resident Canadian and U.S. citizenship. They're collecting can they collect both Social Security and Canadian CPP? And once they pass, is a non-U.S. person eligible to continue collecting the U.S. Social Security?
Yes. That was the
short answer, the short question.
Yeah, they can. The fact they reside in Canada or some other location doesn't change their eligibility for getting benefits. And to the extent that their spouse is eligible for those benefits, I think in the U.S. specifically, they have to be married to them. It cannot be a common law marriage, I don't believe, in the U.S. So as long as they would otherwise qualify for benefits if they were living in the U.S., they will also qualify for those benefits when they're not living in the U.S.
Perfect. All right, and then the next question is if you could please comment on the reporting for U.S. citizens that own Canadian assets such as TFSAs, family trust, Canadian corporations, and RESPs.
Well, that's a short question that probably requires a full hour-long webinar, and we'd be happy to do that. I think that's a topic that our firm in the 2 offices in Vancouver and Calgary, that's a big portion of our practice is helping U.S. citizens who live in Canada, with their tax affairs, and certainly with the help of the preparation of their tax return. Anytime a U.S. citizen has an interest in a non-U.S. asset, there's a whole host of reporting requirements and filing requirements that carry some fairly big penalties if you don't do it properly and if you don't do it on a timely basis. I mean, what I heard there was if you have interests in non-U.S. trusts or a non-U.S. corporation, fairly common for a high net worth family in Canada, they're U.S. citizens, there are some extensive reporting requirements. The IRS wants to know details about the balance sheet, income statement, who owns it, what distributions were made. In contrast, some of the other accounts like a tax-free savings account or a registered education savings plan, while those are still subject to tax in the U.S. Because they're not deferred plans like they are in Canada, there are some exemptions that effectively you don't have to file those same separate information forms to the Internal Revenue.
So it has been simplified in certain cases where they're still taxable. They don't have the same reporting requirements.
That's right.
And sometimes those, we advised clients previously that the best thing to do is avoid those certain plans because their reporting requirements would cost more than any benefit the plan might generate. And now basically that's not true anymore, that Canadians or U.S. citizens could invest in those plans. They still have to pay tax, but they don't have the same reporting.
That's right.
Yeah.
And when we do that talk, I think, Krista, you'll be a big part of that one. So.
We'll give you, we got one more question, I think. And just while we're doing this, thank you for being part of this. We appreciate you being part of Andersen Tax Talk. And
our inaugural live webcast.
I hope it doesn't look like it's inaugural, but I look like seasoned professionals. So, Krista, you got one more question?
I do. So the last question goes back to doing business and hiring of individuals. If there is a service provider that will be providing services to a U.S. company, however, providing those services in Canada, is it best to do it as an individual, as an independent contractor, or through a corporation?
I'd say it really, from a tax perspective, there's probably a bunch of factors considered here, but I'd say you could do it any of those ways. And, it's really about dollars here, saying if you have to form an entity to do it, or, it's going to cost you money. You have to think of saying, I'm going to spend money to incorporate that business. I have to annually file for that business. I have to do all these things. So is the benefit of incorporating worth that? And if every dollar you earn, you actually use to, pay for your mortgage and look after your life, incorporating doesn't make a lot of sense, with one exception, and that is that if there's a liability concern. Again, we're tax accounts here, so you incorporate for two reasons. One is to reduce your tax cost or defer tax, and the other is to limit your liability. Some professionals cannot limit their liability. Doctors, lawyers, engineers, etc., cannot incorporate to reduce their professional liability, but they can do it to reduce or defer their tax. And so that's a longer question. That's a fairly in-depth question. I don't know if you have any other comments on that, Steve?
Well, it like anything, it's fact-specific, fact-directed. We're always happy to sit down and kind of go through any scenario and give our feedback and our strategies as best we can.
Hey, thank you very much for those questions. Stephen, thanks for being on this, what we've now termed our inaugural Andersen Tax.
Well, I use inaugural because I think my father's part of this too. So if I said first annual, that would drive him crazy. So it's got to be inaugural.
and we do have a plan to do more of these, actually. In today's world where we can't meet in the same room or give a presentation, this is the closest that we're going to get to being in your living room or at a conference room. So thank you very much for joining us here, and we appreciate the opportunity to be with you. And I hope that was helpful to you.
Thank you.
Thanks.